Sometimes it's not very easy when you are a professional in the money management space and you hear certain things and you're like, I disagree with that. I don't think that's right. And one of those things is, for example, everybody should invest in an index fund or an S&P 500 being the obvious one.
You're going to trigger people.
I'm going to trigger some people.
According to several studies, more than 70% of retail investors end up losing money. Why do so many people struggle to make money in the stock market?
It's not that people don't make money. It's that people make money, but they also lose money and they lose more money than they make. It's because people don't invest according to their own mandates. The one thing that I have learned over the many years of doing it professionally and as a retail investor myself is that the best investment that anybody can make is one that they can stick with.
A lot of retail investors, they look at what institutional investors do. What's your thoughts on that?
Institutional investors buy and sell things for different reasons. It's not necessarily they're buying because they think it's a good investment at that particular time. Or it's not that they're selling because they think it's a bad investment. They could be selling because they've just found another investment and they just need capital to go somewhere else.
People have this perception that active managers don't beat the market. So then why do active funds still attract billions? What is that about? Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Jacques, who's an investment professional with 11 years of experience in asset management, where he worked on institutional portfolios and gained a deep understanding of how money is managed at scale. Today, he's transitioning into financial planning, combining technical expertise with a passion for helping people build wealth in a more holistic way. Alongside his professional work, Jacques runs a social enterprise delivering financial education workshops in schools and youth clubs aiming to empower the next generation with money skills. Jacques, how you doing, bro? How's it going?
That is a fantastic opening.
Yeah.
That's really good. Wow. I'm doing good, man. I'm doing good. I think the last time I was here was probably a year ago.
Yeah, it's about, just over a year ago.
Yeah, so much has changed. So much has changed.
A lot has changed in a year, right?
So I think back then I was in corporate. I was working for an asset management company. I've been in asset management for about 11 years now. But now things are a bit different. I've since left the corporate world temporarily, maybe not. And yeah, I've been on what we call a self-proclaimed sabbatical.
That's good.
Yeah,
That's good. It's useful to do that, right?
Yeah, listen, I'm telling you, it's one of the best decisions I've ever made. So I've taken a summer off. So I think June the 30th or something like that was my last day at my previous company. Decided to take July off and August off. And potentially September as well. Enjoy the summer. My birthday is also in July as well. Wow. So I've had a fantastic summer, and as you rightly said, I'm transitioning into financial planning after my so-called sabbatical.
Okay. You know what? Before I ask you to describe yourself, people would want to know how comes you've decided to make that? Because obviously, being are you allowed to say now you're investment manager? Right? Yeah. How was that for you? How did you find that?
Yeah, so my previous role, the one I did for the past 6 years, I was working in a portfolio management and implementation team as an investment manager. And I think that was a great experience. I mean, the whole industry of asset management has been a great experience in terms of learning. As someone who grew up in a lower socioeconomic background, learning about assets and the financial markets and how it all comes together. Fantastic experience. Yeah. But I think when I look at who I am, what I enjoy, what I think I can bring to the world, I think is a bit more than working in corporate and managing institutional money alongside other professionals. I think for me, I'm very big on the individual. I'm big on families, and I want to be able to provide financial education, mentorship, guidance, regardless of who I'm dealing with. Yeah. Even from a professional standpoint as well. And I couldn't do that working in corporate asset management as well. And that's the reason why I'm looking to take this next step. And it's a self-employed role, so there's a bit more flexibility as well. Yeah.
It's so interesting because, people have this weird misconception. Oh, you're on this nice cushy job. Why would you leave it? And people just don't understand. There is more to life than just Look, although this is a money podcast, it sounds so fun. There's purpose, right? And sometimes it's like, everybody has an epiphany. When you're helping like a very wealthy company or rich individuals, you're like, actually, wouldn't it be nicer to just help somebody who's not rich, help them get rich? Right?
Do you know what? You can get very comfortable, being in the role and earning decent salaries and progressing, etc. And I think for some people, that's perfectly fine. I just think, like you said, money is not everything. Yeah. It's very important, and don't get it twisted. It was a very difficult decision to make, especially when you are coming from, again, a lower socioeconomic background. first person in your family to go to university. You get this role that's in the front office of asset management companies. To leave it and to leave that kind of like secure income stream during the cost of living crisis, where you've got a mortgage and that kind of stuff, is not an easy decision. But the truth of the matter is, that's why we plan. So I knew I wanted to do something like this for the past few years, and so of course it required me to put some savings away, minimize my expenses, so that I can give myself at least a year runway where I can actually try new things, and that's what I'm doing.
That's important. And you see, like you said, you plan, right? A lot of people want to do things, but they don't plan for it. And you plan for this period of your life. So I think it's a very important message that people should really listen to. If there's something that they want to do, it really should. You're not going to get there if you don't plan for it, right? And do a bit of sacrifice. And now you're able to have the summer off, and now you can transition into financial planning, which is quite nice. Yeah. So, obviously I introduced a bit about you, but if somebody was meeting you for the first time, how would you describe who you are and what you do?
Yeah. So I'll say my name is Jacques Opoku, and I will always do the thing where it's actually Jacques, if it wouldn't be French. Jacques Opoku, in terms of what I believe my purpose is and what I believe I can bring to the world in terms of service, is I want to help the everyday person, the everyday family manage money. Basically, I want them to live their best life without money being the reason why they can't. And the way I try and execute this intention and purpose that I have is often within 3 segments. So the first segment will be my personal brand, which most people will know as Jax Financial. That's JAX Financial. And with my personal brand, I do a lot of speaking engagements. So I speak at churches. I speak at different institutions. I do one-to-one coaching and group coaching as well, which again is similar to financial planning, but I can't tell people what to do. I can educate, I can guide, I can mentor, but I can't tell people what to do. And that's just financial, the brand. I'm able to be more flexible. I can do what I want, albeit can't tell people what to do. Yeah. But that's just financial. That's my personal brand. And then we have my social enterprise, which you mentioned in the introduction, which is called Woke Finance. We are going through a transition of changing the name and rebranding. But we got incorporated back in 2019, and it's a social enterprise that provides financial education, guidance, workshops for young people, often from underrepresented and disadvantaged backgrounds. So actually this summer, one of the things I've been working on during my sabbatical is this passion project where specifically this period, this year, we're working with a specific group of young people, which are like young offenders. So we've worked with like youth justice. We've worked with people that are exposed to gang violence and stuff like that. And we're still teaching them financial education. And that's what we've been doing with Woke Finance for the past 6 years. And I've really enjoyed it. Really, really enjoyed it. So that's the second segment. Again, that's for young people, often between the ages of 11 to 21 from underrepresented backgrounds. And then the final segment is what we've just discussed, which is moving more towards a professional service, which is the wealth planning or holistic financial planning, wealth management, which I'll be doing through my next venture.
Wow, so, you're doing a lot. Man.
Yeah, so I've tried to capture everybody.
Yeah, that's nice. Look, like all the best. Like the other two, I know you're doing that currently, and that's great. And all the best of the financial plan. I'm definitely looking forward to hearing what your experience is like with that. So thinking about your own journey with money, the emotion, lesson, and experience. What's one belief you carry now that you wish more people understood? Yeah.
Oh, I like that one. We're already getting to the thick of things. So look, I think probably from an investing standpoint, I am someone who consumes a lot of social media as well. I watch a lot of YouTube channels, and sometimes it's not very easy when you are a professional in the money management space and you hear certain things and you're like, I disagree with that. I don't think that's right. And one of those things is, for example, everybody should invest in an index fund or an S&P 500 being the obvious one.
You're going to trigger people.
I'm going to trigger some people, but
it's funny because you're an investment professional. You're saying this,
and I have to be honest, right? So. Now does that mean that's a bad investment? Absolutely not. It's a fantastic investment for the right person. But I think the one thing that I have learned over the many years of doing it professionally and as a retail investor myself is that the best investment that anybody can make is one that they can stick with. One that they can stick with, but also one that actually optimizes their objectives, their risk preferences, their risk tolerances and stuff like that, and their time frames. if we don't optimize that way, often what happens is people will just listen to someone on YouTube, listen to even Warren Buffett himself, talk about things like index funds, and that's what they will invest in, ETFs, and that's fantastic. But often there's a reason why people don't stay the course, because unfortunately, it could very well be that they've invested in something that doesn't actually meet their objectives or doesn't actually meet their risk tolerances. And I'll give a very quick example before we move on, which is I've coached some people where one of the questions I ask them is, well, okay, choose a risk level between 1 and 7. And often you hear like 4, some people will say 3, but then they might have been investors already. So I'll say, okay, let's do a portfolio review. You've invested in, I don't know, VOO, QQQ, one of these ETFs that tracks an index. And I said, well, let's look at the fact sheet or the key investor information document, which is a document that tells you what the fund is all about. Yeah. And if you look at the risk number, you will realize that actually it's probably 5 or 6 out of 7. And when they notice, I say to them, well, that means you've not invested according to your own risk tolerance, which means what's going to happen is everybody's a long-term investor when things are going well. Yeah. But the moment we go through some sort of market volatility and turmoil, you are likely to actually sell out at a loss, which speaks to why a lot of people lose money in the stock market. Okay. So that's the answer I'll give you. The thing that I've learned is the best investment anybody can make is the one that they can stick with, but also one that optimizes their objective, risk tolerance, and timeframes.
I appreciate that. I think that's a really good one, and we're going to talk more about that. And we're going to talk about institutional investing and mindset, because I think it is important. And I'm glad that you called that out, because people have very strong opinions online. I didn't know how strong people's opinion was in the UK, not just the UK, just generally about investing, which is good. I always say it's good because it means that people are interested in investing. That's great. It means that you're engaged, you're learning about it. Yeah. But people have very strong opinions, and they're like, it's almost like factions warring, active versus index. And if you're index, you must do this. But I do appreciate what you're saying. At the end of the day, it's one that you can stick to, because things are going to change. Yeah. If you're investing for a long period of time, 15, 20 years, things are going to change, right? So you're right. It is really about something that you can stick to. And I think that's very important. XTB is currently giving new clients a free share in Rolls-Royce when you open an account, verify it, and make your first deposit. And within a few days, that share is yours. I use XTB myself because it makes investing simple and affordable. You pay 0% commission when investing in stocks and ETFs, and you can earn up to 4.25% interest on any cash sitting in your account. You also get access to 10,000 stocks, ETFs, can start with as little as £10 and enjoy quick, secure, and free deposits and withdrawals. It's one of the most straightforward platforms I've used, whether you're just starting or scaling your investment portfolio. So, if you'd like to kick off your investing journey with a free Rolls-Royce share, check out the link below or use code SAVVY and sign up today before the offer closes on the 30th of November 2025. Please note, the free stock promotion applies to the United Kingdom only. Your capital is at risk. The value of the stock may fluctuate. Limited availability. T&Cs apply. So my next question for you, right, is in your career, you worked with people at very different stages of wealth. So obviously, being you an investment manager, what experiences stand out most to you, and what patterns have you noticed in how people approach building and managing money?
Yeah, so I think, that's a great question. I think when you're dealing with individuals, families, institutions that have a large capital base, which is a lot of money, they know that they're good at making money. Right. And I think there's something to be understood about. There's a difference between making money and managing money. There are some people that are very good at making money, but may not be the best at managing money. Yeah. And so those people, a lot of the time, the wise ones will actually bring on board a professional to help them through that process. But then you also get some people that are, very good at making money, but they're fantastic at managing money too, right? They understand all the principles of, earn more than what you spend, or kind of invest the difference, etc. So is that mindset to understand that making money is one thing, managing money is another. And it could well be that actually you may be good at one but not the other, and being humble enough to understand that, to then bring on board potentially a professional to help you through the process. And I also find that actually some of the ones that are very good money managers themselves will still bring on a professional to help them because of their time, right? They're very they care a lot about the efficient allocation of time and their resources. So they know that they are better off doing something else. It's like being a driver, but still having a chauffeur.
Yeah.
Right.
That's true. Yeah,
so they know how to drive themselves, right? But they will still bring on a chauffeur because they want a driver, right? And so those clients are interesting because when you sit in a meeting with them to talk about the markets and to talk about their portfolio reviews and performance, it's an interesting conversation, but it can be very challenging as well because they know their stuff. They really do know their stuff.
So they'll challenge you on questions.
Do you know what I mean? So there's that. And I think one thing I've noticed about wealthy people as well is they care a lot about the details. They care a lot about the details. They care a lot about tax planning. And you'd be surprised when it comes to things that maybe sometimes new money has deal with in terms of, sometimes when it's new money and we don't really care that much about small things. They care about the pennies.
Okay.
Yeah, they really care about, why is this being charged this way? Why is this been done this way? They really care about it. And I think that's something we can learn. Okay. And it's not so much about counting pennies and all that kind of stuff, whatever. But I think it's just the attention to detail that makes them very unique people. Yeah. That's something I've come across. Yeah.
This is what I like about these conversations because it just shows you, right? Like, and I do appreciate what you said about, outsourcing because at the end of the day, right, you're right, it does make you efficient. Just because you're outsourcing, that doesn't mean that you're incapable of doing that thing. Right? Yeah. Like editing, for example, right? Yeah, I can edit. I edited when I first started. But actually, to be able to make more of an impact, I need to do other things and get somebody to help me edit so I can do other things and et cetera, right? And I think that is... I don't know. I think with money, it's so interesting. We're going to talk more about this. But like, I think the way people feel like about financial... like managing money and making money, I think people think all of it should be free and you shouldn't spend no money on doing that. And yes, it's just easy, just put in a tracker and that's it, you're done. Yeah. Let's not, spend. And I don't know, I'm not really...
You're not sold?
No, I'm not sold on that. No, because I'm thinking, if you're going to be making a lot more money, right? Do you really want to just be there? Like, because it's a lot of effort, right? To look at everything every month or every quarter. It's a lot of effort.
I mean, and this goes back to what I was saying earlier about choosing an investment style that best suits you.
Yeah.
Like, at the end of the day, I remember speaking to someone who, wants to invest for themselves and I asked him what sum of money are you investing? And it wasn't a large amount. And I said to him, well, hopefully you grow a portfolio and you love this game so much that you can grow the portfolio to a sizable amount in the future, etc. But if you're going to spend all this time researching stocks and you're only investing a couple £100, even 100% return on £200 is just £200. And that's not guaranteed. And that might be over a long period of time. You might be better off driving Uber that evening. Do you get what I'm saying? Yeah. So there has to be more thought in that conversation as to why we do certain things. And money is very sensitive for a lot of people. People will share, I don't know, this might even sound a bit controversial, but people will rather share a bed with someone than share their money or whole conversations about money. People will talk about things that are very sensitive to them, to strangers online, on TikTok and these places. Yeah. But when it comes to their very personal finances, it's something, And I just think that's just how money is, because money itself is not just this thing that has a head on it or it's just cash. No, it's a representation of a lot of things as a medium of exchange. Some people will say it's their blood, sweat and tears. So it's very sensitive. I understand.
Very sensitive. I do understand it from that perspective. So we want to talk about institutional investing because we've never really covered that, right? And I think it's going to be so interesting for people. But before we go, deep into it, for the people that don't know, when we say institutional investors, what do we actually mean and who falls into that category? Okay,
so institutional investors, I think it depends who you're speaking to, but I'll give you like an overall summary. Ultimately, you're talking about people that have large sums of money, and I'm not talking about individuals. I'm talking about organizations, enterprises, etc. So a lot of them will manage large sums of money, and I'm talking about tens of millions, maybe hundreds of millions, billions even. And often when they are managing money as well or investing this capital, it's on behalf of someone else often. So I'll just throw some examples of what we call kind of institutional money, which is we have like pension funds, that's institutional money, right? Institutional money. different types of pension funds, from defined benefit schemes to defined contribution schemes. These are all institutional investors. We have the mutual funds. These are institutional investors. We have something called endowments, which is a fantastic area, I think, to learn about, which is a big part of my previous job, was managing endowment money. Universities have endowments, for example. We have sovereign wealth funds. So there are states, countries that actually have their own portfolio. A very popular one, I believe, is Norway.
Yeah.
So different types, financial companies, banks, insurance companies, all these companies make use of financial markets, the stock market, to fulfill their needs. And these are what we call institutional investors.
Okay. And how do they differ to like us everyday investors, or the term is they call us retail investors? How does it differ to that?
Yeah, many different ways. One would be a sheer amount of money that they're investing, of course, is significantly much more. Institutional investors have very specific, unique, nuanced mandates. So they're really trying to achieve something specific. And I think retail investors can learn from that. So we can talk about that. So an insurance company's strategy, investment objective, and how they pick their asset allocation, etc., will be very different to, let's say, an endowment, right? And that would be very different to a pension fund. That could be very different to a mutual fund, right? And so that's important to understand. But also, there's constraints. There's so much you can do. So there's a lot of regulation when it comes to institutional money as well. Okay. So I think on the top of my head, those are the key differences I can think about. The fact that they've got a huge amount of money, they have very specific mandates and constraints, and very unique goals that they're trying to achieve for their institution.
Yeah. And what would you say the main advantage institutional investors have? Because everybody thinks that, they have like brilliant people like you, analysts and stuff like that. But is there anything else that they have as a major advantage over, like, everyday investors?
Yeah, I mean, first and foremost, I think access being a very key word in this. I think having that very direct access to, let's say, CEOs of companies. So I've had the privilege of sitting down with some CEOs, CFOs of some of the companies that people invest in, and listening to what they're questioning them, asking them questions. I don't do a lot of the questioning. I kind of just sit and let the main fund manager do a lot of the questioning, but listening in and listening to the information that they will give, not inside information, but just more information that you might only really hear in a conference call or earnings report, for example. So that access is very important. And even going further with access, also sometimes they benefit from, not sometimes, all the time, they will probably benefit from economies of scale, which is being able to buy in bulk, which also means there are certain assets that you can invest in as an institutional investor, but you can negotiate fees. So I'll give you a very simple example. When you're buying like a mutual fund, they will have different share classes. Sometimes it'll be like a P or a Z or something like that. Sometimes we say accumulation, distribution. These are share classes. Institutional investors can create their own share class with that fund, which means they're still investing in the same thing, but their route into that fund is different, which means they might pay less fees. And that's because they are actually investing more money, right? Companies can also do something called private placements, which means they'll actually just go to the institutional money. They wouldn't even do it to the public. So there's all of that.
A lot of that one, the private one. Yeah.
Oh yeah.
Even doesn't that happen a lot with? Correct me if I'm wrong. Does that happen a lot with IPOs?
Yeah. So I think even when we talk about like private markets, which is a huge conversation that's happening in the industry right now, which is, for example, companies are staying private for longer. They're not coming to the public stock market as much as they used to, which opens them up to a lot of regulation, and they have to keep up certain things like quarterly returns and stuff like that. But private markets is a huge conversation right now. But who has access to those private markets?
People got lots of money.
So it's institutional money, right? They can invest in unregulated, sometimes depends which institution, but they might have access to unregulated products like hedge funds as well. So lots of advantages that they have, but also some disadvantages too. We can touch on that as well.
What are the disadvantages? Let's hear it, because this is no, I'm finding this fascinating because it just shows you, I think for a lot of people, right, it's obviously advantage and disadvantage. You mentioned mandate, which is quite interesting that they've got a mandate, which is quite unique, because I understand that they've got, but then that also means that that's a restriction because you have to almost follow that mandate. Were they quite flexible on the mandate, or was it like, no, we're doing this for 5-10 years kind of thing?
They will have a very specific mandate that you can't completely deviate from.
Wow.
And that's all agreed on the outset, right? So you would write an investment policy statement, IPS, and that's basically like what we're going to do to do the mandate, to get the mandate done. So you can't deviate too much away. Otherwise you'll be sat in that meeting explaining why you did something that probably didn't work, that was completely away from the mandate. And you can get in trouble for that. So yeah. Remember, think of it like this, right?
Yeah.
A pension fund has it's trying to, so for example, a defined benefit scheme, the whole purpose is nice, is long term, but they're trying to create a portfolio to match long term future liabilities.
Okay.
Which means in the future they are going to pay out. These companies are going to pay out
for when anybody needs their pension. They have enough. Yeah.
Right. So you can't just decide, okay, even though you're a pension fund, a defined benefit scheme, we're going to put your portfolio on 100% equities. No, that's not going to run. Crazy, you can't just go and stick in the S&P 500, right? Yeah. What you probably do is you will have quite a few government bonds, gilts in the portfolio as well, because that's how they're structured. They're very good for, and I know you don't like technicality, so I'm avoiding.
No, I don't like it. It's for the people. It's for the people. Explain it all. Yeah,
it's but there's strategies like immunization and managing duration risk and interest rate risk and all this kind of stuff. Okay. But essentially, what we're trying to do is we're trying to match the cash flows of certain assets, knowing that in the future you're going to actually pay out these cash flows. So you have to follow that strategy. You can't just go and start buying penny stocks or anything like that. Yeah.
Okay. That's so interesting. Now that you're saying this makes sense. So you mentioned insurance companies. So does that mean also insurance companies are also investing in a way to also pay out their liabilities as well?
Yeah. So insurance companies will be a bit different.
Yeah.
So this is what's fantastic about investing and why I love to educate, because it gives new perspective. So insurance companies will be different from pension funds in the sense that they require more liquidity. They require more liquidity because there could be claims at any moment. So again, their structure will be different because they need something available to pay out clients should clients claim. So their mandate will be different. And then endowments will be very different as well, because an endowment, the time frame for an endowment is into perpetuity, is infinite. So their structure, or what they're trying to achieve, is we're going to invest to benefit current projects that we're working on, or some of these companies are trying to pay out grants to students and stuff like that, but they also need to think about the future into perpetuity. So they want to make sure that their portfolio has growth in it as well, so they can take a bit more risk. So they will have maybe a higher allocation to equities than something that requires less risk. So notice all of these institutional investors I've mentioned are not the same.
They have different mandates. It's crazy because you just remind me. So Oxford, University of Oxford was a client like about a year ago, and what I learned whilst I was working there was that I heard that they're so wealthy, or the uni so wealthy from investing, and that really blew my mind. I was like, oh my god, this is so crazy. But it's and what this tells me is that, and I think you kind of mentioned this in the first conversation that we have, a mandate is almost like your goal of what you're trying to achieve, and everybody has a different goal. So that's something that we can kind of take from institutional investing, right? What is that overall goal that you're trying to achieve? And as you mentioned in that episode, plug again to go and watch that one. What are you investing in to meet those goals? And I think it's a very good way to think about it. I want to go back to something, gilts, because we never mentioned gilts. What is gilts?
Oh, sorry.
No, it's fine. What is gilts? Because you mentioned bonds, and I'm going to tell people to go listen to that episode. I'm not going to ask Jacques to say what bonds is. Go listen to that. He explains that one. But what is gilts for people that don't know what that is?
Sorry. So gilts are government bonds, right? So when we hear bonds, we just think of borrowing. So we can borrow to the government. We could also borrow to corporate. So I think I might have explained that last episode, that those are known as corporate bonds. But when we borrow to the government, because guess what? The government needs some money, right? Those things are called gilts, government bonds, essentially. And I think they're called gilts because historically, when they were in bearer form, which means it was actually a certificate that you can have to say that you've got this gilt. It was it had a gilt edge, so that's why they're called gilts.
Okay.
But essentially, you're borrowing to the government, and why that's important is because it's seen as somewhat, to a high extent, it's seen as a risk-free investment. Okay. You will get a decent yield on it depending on the interest rates. And it's something that makes a huge part of a lot of institutional portfolios. Government bonds and other bonds, the role they play in portfolios differs. As I said earlier, if you're trying to match liabilities and stuff like that, it can serve that purpose. But also when you add government bonds and other asset classes to your portfolio, you have a portfolio perspective, and bonds allow for a much more smoother journey when you mix it in with equities. Yeah. And that's what portfolio managers is really about. If you have a 100% equity portfolio or stock portfolio, like an S&P 500, is going to be more volatile than if you had historically, we had the 60-40. That was the most popular one, which is 60% in stocks, 40% in bonds. Because if you have that, the journey will be much more smoother. It will not be as volatile as just having stocks.
Yeah. And this is an interesting question because, everybody, I think, is prone to mistakes. I don't think there's anybody that's like infallible, but I'm going to ask you anyway. Do institutional investors always get it right, or do they make the same mistakes individuals do, just on a bigger scale?
That's a great question. I mean, of course. I mean, mistakes are mistakes, and I guess it depends what kind of mistakes we're referring to. Do institutional investors always outperform the market? No, that's most definitely not true. But do they often create a portfolio that is there to optimize the client's objectives? Yes. But of course, that's why you have to meet the client often and discuss what's happening in the portfolio. Do we need to adjust? A lot of institutional investors will also do something called tactical asset allocation. And I'm going to explain what that is. So normally you have something called strategic asset allocation, which is part of the initial process. I might have mentioned this last episode, which is we decide, okay, we're going to do 70% equities, 30% in bonds. Let's keep it simple. And that's that portfolio we've just discussed is optimized for what you want to achieve, right? But it could well be that, as we do some macroeconomic analysis and we listen to what's happening in the market, we think maybe for the next quarter or next 6 months, maybe even a year, we think that equities will outperform bonds, or actually bonds look like they're of good value right now, so we want to do a bit more bonds. Then we might tilt the portfolio. We might be tactical and say, actually, we might do 65% this time in equities and 35% bonds, or go the opposite way, do 75% equities and 25% bonds. That's fantastic, and that sounds all great, but it may not work. Okay. It may not work, and often people get it wrong. Investors get it wrong. Institutional investors get it wrong. Things don't always pan out how you would have thought. Maybe you thought that interest rates were going to go down, but it didn't, and that affects the portfolio mix that you thought was going to do the best.
Okay, and how often is that happening? That tactical switch, and thinking about that. Yeah. So
in previous companies, particularly the last one I worked in, it was happening on a quarterly basis.
Okay, so every quarter. Is it like in the retail? Because I try and translate to the retail. We often talk about rebalancing your portfolio. Is that? Would you liken it to something like that? Rebalancing in a way? Or?
Yeah, you're. It's probably the opposite of rebalancing. You're adjusting the portfolio mix to try and capture what you think is going to do well over the next quarter or 6 months. So what rebalancing ultimately is if you've got your strategic asset allocation, and because the market moves as it does, it comes out of kilter, right? And then you rebalance back to your strategic asset allocation so that it still remains how you wanted it to be. And that's great because you're essentially taking profits from the ones that's done well, and you are buying the ones that haven't done well at a cheaper valuation. Ultimately, that's what rebalancing really is. And in theory, that should end up in outperformance. So rebalancing is good for that purpose, right? But tactical asset allocation goes one bit further to say, actually, it's not just about rebalancing. Actually, it might not even be the right time to even take profit. Actually, we think it's going to go further. So let's keep this next asset allocation for this period not too far. And I just want to mention that because remember, the mandate will tell you how far you can go. Yeah. The mandate will be like, actually, you can't go further than 5% overweight, what we discussed will be our strategic asset allocation.
Okay.
So if we say, all right, cool. Based on what you're trying to achieve, 70% is what the equity element is going to be. But we think equities are going to do really, really well because of the big, beautiful bill and all these things that's going to go well. Then we can go only up to 75, even though maybe I think at this moment we might do well going up to 90. Your mandate says this is the range. You can't go above that.
Okay. Wow. Yeah, this stuff is there. This is so fascinating to me.
Yeah.
Is there like, I know this might be different for like different, funds or firms or institutions, let's say. Is there like a minimum, I guess, company size that they can invest in terms of like the valuation?
That's a great question.
Yeah.
Do you know what? Actually, that speaks to one of the disadvantages of being an institutional investor, which is, think of someone like Warren Buffett, right? Warren Buffett himself, if he's invested for his own account, will be a retail investor, but he manages Berkshire Hathaway.
Yeah,
Berkshire Hathaway is an institutional investment, right? Or investor. And so, using him and as an example, he can't just go and buy shares in small cap companies because he will end up buying the whole thing. I mean, he does. Ultimately, he does, right? And so yes, it's true that when you are an institutional investor, ultimately you have to know what you can buy and what you can't buy. There are some mandates that will say you only stick with large cap equities, which is only large companies. But also, yes, if you are investing in companies that are too small, you take too much of a majority stake. Okay. The flip side to that is that could be part of the objective, what you're trying to achieve. So in previous companies that I worked for, investing in socially responsible companies was a big thing. Stewardship was a big thing. And so you would take a position in a company so that you can actually speak about where you think they should go in terms of their stewardship, their environmental, government, and social responsibilities. Okay. So that's another benefit of being institutional. So benefits and costs. Benefit is you've got so much money, you can take a majority stake, or maybe not a majority stake, but a sizable stake in a company, so that you can actually have influence as to what policy is taking place. And I'm sure you've probably heard of like activist investors who actually go and do that so that they can make change.
Yeah, some of the serious ones. Yeah, I've heard some of them, like even trying to get people fired.
Oh yeah, like CEOs and stuff like that. Yeah.
That is crazy. So I wanted to also talk about the different styles, right? So what are the different styles of institutional investors that you know of?
Yeah, big conversation. Yeah. So it depends on what I've given you some examples already. Yeah. So an insurance company, a pension fund, an endowment, a sovereign wealth fund, they will have different styles of investing, right? Because they will have different mandates, things that they're trying to achieve. Yeah. There are some investors that will focus much more on the whole kind of, example I just gave you was charity investments. Charity is a big sector, by the way, and I don't think retail investors even know about this.
Not really, no.
Yeah, it's huge. I would say probably my last company was one of the biggest, it was probably our biggest book of clients, right? I'm a Christian and I talk about churches. Churches have huge mandates as well, right? They have investment portfolios. People don't know that. But their strategies will be different as well, in the sense that, look, if you want an endowment, you're trying to generate cash flow. Yeah. Right. So you invest in bonds, you invest in maybe dividend paying companies, but also if you're an endowment, again, like I said earlier, the time frame is into perpetuity. So you need growth. You want to generate growth ahead of inflation because you're trying to keep this endowment until you're gone, into perpetuity. So your asset mix will be very different as well. There's people that will focus on I mean, some institutional investors will focus on things like factor investing. Some of them will look at, okay, I'm doing jargon again. Let me start again. There are some institutions, and I'm actually talking about investment companies, who their strategy will be, let's say, top down. And I'm going to explain what that is, which is they will look at the macroeconomic environment, macroeconomic backdrop, and say, based on what's happening with policy, geopolitics, whatever, we think this asset class would do better than this, etc., etc. And that's a starting point. Based on that, they will then move to that strategic asset allocation I was talking about, which is, okay, now we'll put X amount here, X amount here. And then post that, they will do the whole kind of tactical asset allocation. Yeah. And then post that, they will do something called stock selection. But even before stock selection, I'm giving so much information. I hope the listeners are enjoying it, which is, They might even decide what sectors they're going to go into, right? So in the equity world, there's like 11 sectors. There's financial companies, there's communication companies, utilities, and these sectors behave differently to what's happening in the macroeconomy. So financials and others might be cyclical, which means they respond to the environment differently. Some may be more interest rate sensitive, like real estate, like REITs. REITs are real estate investment trusts. They're very sensitive to interest rates. So based on that macroeconomic viewpoint, you also decide how you're going to do your stock selection. But then there are companies such as Warren Buffett, institutional companies, which are not macro or top down. They're more bottom up, which is they focus much more on the actual businesses. Right, they're value investors. They're looking at the actual company's financial statement, their balance sheet, their income statement, their cash flows. They meet the companies, and they're much more focused on the actual company, and they don't really care what's happening in the macroeconomic environment. So, again, huge topic, and we could spend a whole episode talking about the different strategies. But I've just kind of given you how a lot of the portfolio managers will function.
Thank you. No, I appreciate that, because that is very important, I think, to understand like how those strategies like differ to what we do as retail investors. And you know, another thing I noticed, and I don't know if you've seen this, a lot of retail investors, not when I say respect, they look at what institutional investors do. What's your thoughts on that? That like, so for example, let me say Tesla. They'll look at like a lot of institutional investors are investing in.
Oh yes, I see
Tesla.
what you're saying. Yeah.
So therefore, is a good bet. What's your thoughts around that whole rhetoric? Because that kind of does impact how we invest as retail investors, right? Because it might give you a level of confidence. Like, oh, okay, Warren Buffett's invested in it, so therefore should be a good investment type of thing. Do you get what I mean?
I fully get what you're saying. So I think is it 13F filings? I forgot the actual terminology is, but a lot of institutional investors are required to speak about or let people know what they invested in on a quarterly basis. And so there are some people that actually will look at these things and say, "Oh, Warren Buffett bought shares in Apple, or he sold shares in Apple, so that means I probably should do the same." And I can understand the very simple mindset of why someone would think that. But I think it's very important to understand that institutional investors buy and sell things for different reasons. It's not necessarily they're buying because they think it's a good investment at that particular time. Or it's not that they're selling because they think it's a bad investment. They could be selling because they've just found another investment and they just need capital to go somewhere else. It could be that they're just rebalancing their portfolio, not because they don't think it's a good investment anymore. If it's a fund like a mutual fund, there's mandates. You can't hold more than, let's say, 10% in a single stock. So they might be selling because we're too close to the 10%, right? 9.7%. So we're selling down to 8% so that we don't go overboard and breach our mandate, right? So you have to be very careful as to why someone is selling and why someone's buying and know the reason behind it. Using Warren Buffett as another example is, it's a huge company with so much cash. So they can't go and invest in everything. There's a reason why Apple is their preferred investment or holds a big weight in their portfolio. Of course, they believe in Apple. That's why they've invested in it. But because Apple's such a big company, by them investing a lot, it doesn't move the market against them, right? So it's important to understand these things as well. Does that mean retail investors shouldn't pay attention to what institutional or what they call smart money is doing? I think you can pay attention. So if someone like, I read someone that came into light was Bill Ackman, who manages, I think it's called Pershing Square or something like that. He's taken a big stake in Uber, for example. And that's interesting. That's I think for me it's interesting, and you should use those opportunities to just think, oh, if he's doing it, maybe I should go and do further research to see why he is interested and whether it actually matches my objectives and what I think as well. It could well be that, because they get it wrong, like you were saying before. Bill Ackman himself, if you go and listen to his story about times when he nearly went bankrupt and situations where he faced, even when he was going through his divorce and stuff like that, you would realize that they don't always get it right. Because guess what? Nobody has a crystal ball.
Exactly.
Nobody has a crystal ball. So to answer your question, I think is interesting to pay attention to what smart money is doing. But it should be used as just an additional piece of information that we can add to our inventory to say, okay, if Bill Ackman's buying Uber, then okay, maybe I should be looking at Uber as one of my many different stocks I'm researching.
Okay. I appreciate that, because I think it's important to just state that and talk about that. And it's good to get it from your point of view and what you think, because honestly, I think it's good, like you say, it's good that, oh, that's interesting, let me do further research. But your investment strategy shouldn't be based on that.
No.
On that, yeah.
Do you know what it is, bro? What you can watch two very well-known investors and they could be doing opposite things. So what do you do then?
Exactly.
Right? Again, you don't know why they're doing it. Yeah. That's something that you have to be mindful of.
Exactly. Like you say, you don't know the reason why. Everybody, like you say, everybody has their reasons why. Liquidate, whatever. Maybe I need the money. Look, Christmas is coming. I don't know. Right? Whatever it is, right?
No, you're right. Look, there's times where they might just be liquidating because if you're following like a mutual fund or someone who's managing a specific mandate, because the clients ask for money. Yeah. And they need liquidity. Yeah. So they need to sell just to raise cash.
Yeah.
It's not because they don't like an investment anymore. You know?
So, over 70% of people who watch these episodes are subscribed. If that's you, hit the subscribe button. It really supports the channel, it helps it grow, and most importantly, lets us keep bringing you valuable conversations like this one. Plus, you'll be the first one to know when new episodes drop. Thank you so much for your support so far, and enjoy the rest of the show. Are there any other lessons that you think us everyday investors can take from, institutional investors? We've talked about a lot, to be fair, so there's no more, but yeah, it'll be interesting to hear if there's any more.
No, I think it's really this. I really want to nail this down, and I think if there's anything listeners can really take from today's episode is, we should be investing according to what we're trying to achieve. It's not just about dividend investing or growth investing or index funds only. It's not really about that. It's understanding and learning from even institutional investors that actually we should all have mandates. We should all have our own investment policy statements to say, why am I investing in this? What is the purpose for this specific investment? What am I actually trying to achieve with this investment? And is the portfolio that I'm constructing optimized in such a way that I can actually meet this goal? If you've got less than 3 years to invest, you shouldn't, in my opinion, be in equities, because equities are volatile. But if you've got 20 years, then damn, yeah, you probably want to be majority in equities. And that's just based on theory and history. However, even after that, it could very well be that you as an individual, you're not built for this. You're not built to deal with the volatility. And I say that carefully because even as a retail investor, and I mentioned this last episode, that like I built a portfolio to 6 figures, and then it got to a point where I was like, actually, my risk tolerance is not what I thought it was. Because the volatility was now really starting to affect my own emotions, right? And so the analogy I want to give here is, let's say we're both trying to make it to Bali. We both want to travel same day. We're both trying to go to Bali, and we have 2 different planes that we both can take. One is a big plane, huge plane, and one is a small jet, private jet. And I'm not sure if this is actually true, but for the sake of the analogy, let's assume that big planes are less turbulent than small planes. I think my common sense tells you that should be the case because of the wind and stuff. It could well be that because you have flown so many times in your life. By the way, I don't like flying. I've traveled to many countries. I fly. Yeah, I fly.
I travel a lot.
Really, I fly a lot, but I've never liked flying, right? And I most definitely do not enjoy turbulence. Yeah. And so because I don't like turbulence, you might say to me, or the flight attendants might say, if you take this smaller plane, you will experience quite a bit of volatility, but you're going to get to Bali much faster. Than if you take the big plane, it's going to be much slower, but you won't feel the turbulence. The question is, which one do you go for? Yeah. Some people will be like, I fly all the time. I fly private jets all the time. Let me get a private jet and volatility, whatever. I've flown so many times. I'm good. They will take that private jet. They will get to Bali faster. But Jax, I'm taking that big plane. I don't want turbulence. Even if it takes me 2-3 hours long, I'll rather take that plane because I don't like turbulence. That analogy is very, very important to understand, because investing is just like that. Okay. The reason why people invest in assets that may have that mix of bonds and stuff like that is because that journey is just smoother. And if you do that, and like what I said earlier, the best investment is the one that you can stick by, because guess what? Some people get into that private jet not knowing that it's going to be a very shaky ride, and guess what they do? They fly out, they jump out. Some people even blow up their whole portfolios and never fly again. Never get back into the portfolio, never get back into stocks.
Yeah.
So you really have to understand why you're investing and what you're trying to achieve, and make sure it is aligned with your own risk tolerance. That can also come down to, you know, they talk about your capacity for loss, your experience, your overall wealth. Some people have so much money that if the volatility, it doesn't even touch them. Whereas if you've invested all your money, you've worked many years, like I did, the example that I used, and that 100k portfolio that I built was my entire net worth, then actually, I should not be a 100% equity portfolio. I can't handle the volatility.
It's important. It's very important. It's very important. And thank you for the analogy, because I think that explains it quite clearly. And actually, I wanted to ask you a follow-up question about, you know, people blowing up. Because I actually got a stat, right? So it's I'm going to say according to several studies, because I think the stats vary amongst, you know, different places, but generally speaking, right, they say that more than 70% of retail investors end up losing money. Why do so many people struggle to make money in the stock market? And I think you talked about people blowing up their portfolios, but can you kind of, you know, even through your experience of helping people do portfolio reviews, you invest in yourself, stuff like that?
So it's not that people don't make money, it's that people make money, but they also lose money, and they lose more money than they make. So what I mean by that is, I've answered part of this question already, in the sense that it's because people don't invest according to their own mandates. They don't create portfolios that actually meet their objectives, their timeframes, and their risk tolerance. And so everybody seems to be a long-term investor when things are going well. It's only when the stock market starts to take a correction or goes into bear market territory that you start to realize that actually most people that said they were long-term investors are not long-term investors, and they sell at losses. So I think I'll probably say that's the majority. The second one is what I spoke a lot about in the last episode, which is to do with our behavior. There's a huge study when it comes to behavioral finance, behavioral economics, and how people behave. And in fact, actually, that's what economics really is. It's a study of people's behaviors. It's a social science. Because the truth of the matter is, I can't remember who coined it. It might have been Adam Smith in the book called The Wealth of Nations, I think. But he talks about the animal spirits. It's like animal spirit. When the first time I heard it, I was like, "Ooh, that sounds a bit scary. That sounds like some Nollywood animal spirits." But no, the animal spirits and the way it manifests is often through, the way I see it, is often through greed and fear, right? So, what do we do when we are in trouble? We are either going to fight or flight. So being anxious and stuff like that. And a lot of the time what happens is when the stock market is going up and things are doing well, and whether it's stocks, whether it's crypto, whatever the asset class is, whether it's property, people get excited and they pile into it. If talking about property, think about over the past pre-2020, pre-2019, how many people over-leveraged, got so many properties. Everybody started a property company. Let's be honest, right? Why? Because, and the truth is, they never really understood the reason why property was doing so well was because the macroeconomic backdrop was good for all assets. There was asset inflation, right? A low to no interest rate environment, very good for property and very good for other asset classes. But a lack of education means that they're over-leveraged. And leverage is also a big problem. Even in the stock market. Many people go into the stock market and they want to do things on margin. They want to do option trading. They want to do spread betting. They want to do something called CFDs, contracts for difference. They really try their best to make as much money as they possibly can. And that gambling mentality causes them to lose money over the long term. The house always wins long term if you're going to gamble, right? You may make some money in the short term, but over the long term, it's unsustainable. It goes back to what I want everyone to remember. The best investment you can make is the one that you're going to make positive returns, but the one that you're going to stick to for the long term.
So do you think that the investment strategy that you feel like you're going to stick to will make you more stoic on both sides? Do you think that's going to make somebody a bit more? Because what you're saying is, you're right, it's down to a lot of emotion. I mean, don't get me wrong, if my portfolio is up, I'm happy, but you're right. Like, if it's down, I don't feel as... I'll say I'm more clinical when it comes to it, generally speaking. So how can people be more clinical and not not just blow up their portfolio, but just leave the stock market? Because leaving the stock market to me is like, it's a travesty, right?
Yeah,
like
it's sad. For me, it's sad.
Yeah, it's sad, right?
Yeah,
like
because it's the number one wealth builder.
Yeah. And you're leaving it because of, okay, yeah, don't get me wrong, it's bad. Like you've maybe lost everything, or you lost a huge part of your portfolio, but what's the alternative not to do it?
Yeah, so I think one thing people can probably do practically is maybe go and take an online risk profiling questionnaire that will kind of tell you your own kind of risk tolerance level. That will be very, very useful. Another thing that people can do is only invest money that you're happy to see volatility on. So don't look at your investments as in isolation. I tell people to look at everything from a portfolio perspective, right? So even your home is part of your overall portfolio kind of thing. So you look at your asset allocation, how much is in property. Don't look at it separately. And that can help you to understand that actually maybe you've got too much invested in the stock market. And then just try some mental gymnastics. I give you an example. I tell people all the time, close your eyes and I say, wherever you've invested right now, just imagine it going down by 30%. If you want to do the maths, get a calculator out, wherever you've invested, multiply by 0.7. Look at that number. How does that make you feel? If you saw your portfolio drop to that number right now, how does that make you feel? And if it makes you feel some type of way, you need to adjust that portfolio, right? And maybe go into more cash type investments or lower risk investments, and stuff like that. So consistently doing that will help. Another thing that I've done in the past, and remember, I'm doing this even as a professional, is I've got accountability, right? I've got a friend who I run Woke Finance with, the social enterprise, and whenever I'm buying stocks and that kind of stuff, I discuss it with him, right? And he keeps me grounded because I'm a human being. Listen, we are human beings. Our emotions can be our deciding factor most of the time. Where AI is going up. Everyone's investing out. I don't want to miss out on this trend. I don't want to miss out on this new currency or crypto that's come out. You jump in it because guess what? Nobody wants to miss out. We all have the fear of missing out. That's the truth, right? But if you cannot explain to a 7-year-old why you're investing in something, the chances are you're not investing. Like I said, you are gambling. It's really just playing on that. People have the goals. I want to be rich. I want to be financial freedom. And you got this thing that's making other people financially free. Are like, I don't want to miss out on that opportunity to be that. I want to talk on that very quickly, because I think it's so important, so important for people from, and I use my demographic, people that maybe your first generation, first person in your family to own a property in the UK, first person to maybe work in a certain job in banking or whatever it is and earn a certain amount. You don't have the experience that other families do. Yeah. And that provides a potential problem in the sense that you may be trying to catch up. Yeah. And you're trying to catch up by trying to get on a fast vehicle, the private jet that I mentioned before, because that's the thing that's going to get you there faster. Yeah. But because you have no experience being on this thing, you're flying something that you're not used to, the moment you experience that volatility, you're going to jump out kind of thing. So actually, I submit to you that actually most people that are building wealth for the first time in their families probably need a more reserved approach, because that approach probably is the approach that they will actually stick with kind of thing. And that's one of the things that I've learned over the time. My portfolio management now is less so in kind of small cap, high volatile stocks. No, especially now I'm on my sabbatical, my portfolio is significantly in something called money market funds because it's low risk. And regardless of what happens in the news, it doesn't touch me because the portfolio I've constructed for myself now completely matches my current situation and what I'm trying to achieve, which is still very different from when I was single, didn't have a mortgage, living in my mum's house. The strategy was very different. But even though theoretically I was positioned to have a more risky portfolio, because I didn't have the experience of volatility, I almost jumped out. And luckily, to be fair, I actually did it before the 2022 borderline kind of almost stagflation period where we had high interest rates and stuff like that. So,
It's interesting you say that first generation wealth builders should try to be more steady, which, you know what? I get what you're saying. I'm not going to say I completely agree. I get it though, because I think it's down to capability, like you say, right? If you do go on the thing that's too fast, the cryptos, I would say stock investing, single stock investing, especially if you don't even know what you're doing, you're right. You're likely to blow yourself. You're like, oh, rubbing your hands, getting there. Oh my God. Maybe it goes up a bit and you're like, oh, this is nice. And then, it goes down, it goes down, it goes down for a while. I remember, you know what? I don't know if people knew this, but like I invested in crypto a long time ago. It was 2017. I didn't keep on investing, but my portfolio at one point, I'm pretty sure, like my Bitcoin and Ethereum was down 80, 90%. If it was money I needed, right? I've spoken to other people that had invested around the same period and said they took their money out.
Yeah.
Like, no,
but that's because your temperament was different.
My temperament was different. Yeah, I was like, you know what? Let me just see what this thing will do.
And you didn't invest your life savings.
Yeah, no, I didn't.
So it's when I talk about people being more reserved, it's more about having your overall portfolio structured in such a way that your needs are taken care of. Yeah. Right. So you've got, we talk about emergency funds and whatever. And then of course, like my favorite investment style for the average person and for myself is what we call a core satellite approach, which is whatever your capital base is and how much you've got to invest, take a large percentage of that, 70%, and invest in, it could be index funds. Yeah. It could be anything passive, whatever. It could be a mutual fund. It could be I prefer multi-asset index funds. Yeah. Or it could be some sort of target retirement type of fund. And just let it do its thing. And then the 30% or 20% you've got left, do you know what I mean? Have some fun with it. Right? Because if you blow that up, at least you still got the rest available.
Exactly.
Right?
So did you say 90? Was it
I said 70-30.
70-30, okay.
There's
cool.
no right or wrong answer.
Okay.
I think you can decide how you want to do it. And I guess this is why I talk about people even needing financial planning. Everybody's situation is so different. There's nuances, there's unique circumstances, context. So there's no one size fits all. Yeah. But I think the key thing is, and I want to say it one more time, the best investment strategy is the one that you can stick with, because guess what? You stuck with yours. Yeah. Whereas other people didn't. So the question is why.
And I still got my Bitcoin. Yes, I still got that there till today. So, okay, so if we're talking about strategy, how do people figure that out? I like the core satellite, actually. I think that's a very good example. How do people figure out what strategy works for them? Yeah, because that's the tough part.
It's a tough part.
It's a tough part to see. For you, you've discovered it, but you were also, if I'm being very honest with you, you were real with yourself. A lot of people might not be real with themselves. Might have just tried to stick it out. At least you were like, you know what, I've got here. Let me readjust. I don't really like the way this is, and you make changes, right? So how can people kind of figure that out for themselves?
I think it is about getting that experience, right? So I would encourage, it is my heart's desire that most people just get started with some small amount of money, regardless. So go out with small amounts of money. Try crypto, try dividend investing, REITs, which provide a cash flow, which is a style that I really like, because every time my phone buzzes and it's like, oh, you've got £10 here, £20 here is a dividend. I like that. Right? Some people might actually prefer that. So you have a whole school that much prefer income type of investing, dividend investing. So I would say try all of them out, but never forget that ultimately this is not just about making money. It's also about creating a solution for your financial future. Yeah. Which is why the core satellite approach is really important. Maybe the core should be capital that you've put to work to meet very specific needs, as we spoke about in the very beginning of this episode, about being very strategic and intentional with your investing. And then the rest is something you could just test out. Yeah. And so if you have a lot of volatility, if it goes wrong, then it's okay, because it's not your whole life savings, and you've got all your other needs, whether it's retirement planning, investment planning, estate planning, whatever it is actually already sorted. Yeah. I think that's the way to look at it. I'm just very cautious sometimes with certain styles of investing, because it can work for so long and then it doesn't work anymore. Yeah. And the worst thing that can happen to a gambler is for them to win the first round.
That's true. And in investing, you can be lucky like that. In crypto too, you can be lucky. It's the truth,
When we talk about investing, regardless of what the asset class is, it could be stock, shares, crypto, property, regardless of what it is. If you didn't really understand what you was doing in the first place and you won and it went well for you, guess what you do? You end up betting bigger stakes.
Yeah.
And that becomes more damaging if it doesn't go your way.
Exactly.
So that's why I'm a bit cautious. But that's the way to mitigate that kind of risk is education.
Yeah.
Become very knowledgeable about what you're investing in.
And that's the thing. I think you should always educate yourself because things shift and change. You know? And actually talking about things shift and change, right? So we were talking about this offline. You know, so we were talking about the debate episode that I recently is out now by the time we discussed this, right? So people have this perception anyway that active managers don't beat the market. So then our thinking was, okay, so then why do active funds still attract? They attract billions, not millions or 100,000s. They still attract billions. So what is that about?
It's a question I had to ask myself. It's like, especially as someone in the industry, you know, I want to be honest and integral. Why should we have active mutual funds that don't perform better than the S&P 500 or any index, you know, or benchmark? This doesn't make sense. Ultimately, you want the best. And I think, so I asked myself that question and I've really done the research. And I think ultimately it really comes down to all that we've discussed today, which is funds are not just there for performance purposes. A lot of the time they are there to provide a solution, which could be, and I give you a couple examples so it makes a bit more sense. So for example, it could be that they want to cater to certain clients that will not want to invest in, I don't know, like fossil fuel companies. So there are some companies that will not invest in the FTSE 100. If you invest in the FTSE 100 as an index, but there's a lot of tobacco companies and energy companies in there. So a mutual fund may come and create a solution to that. And they'll still benchmark against the FTSE 100. But the solution ultimately is to strip out some of these companies. But it could well be that because they've stretched out some of these companies who have these products that may be even quite addictive and the stock price is actually shooting up, they'll actually underperform the index. And that's why they have very, very specific types of clients, because they can explain that to a client and a client could be like, okay, I understand. And that's absolutely fine. So that's the part that a lot of us retailers miss. But the mere fact that all these funds still exist and new funds and new solutions keep coming should give us some sort of inclination that they must serve a purpose. And that's the example that I actually gave. And one thing I will also say is it is impossible for everybody to be an index investor. In fact, the only reason why we can invest in index funds or passively is because we have active investors. Someone has to keep the market honest in terms of valuation and price, and in terms of keeping the market as efficient as possible. And so, that's one of the reasons why active investors will exist. If everybody started moving towards index fund investing at some point, then yes, at some point, active investment will create, or there'll be opportunities created for the active investor to outperform.
Really?
Kind of thing, yeah. Because just how the market works. There'll be valuation, there'll be some sort of dislocation with the market price and all that kind of stuff, because everyone's money will just be going to buy NVIDIA.
Yeah, that's a good point. You're right. It would be allocated to the same thing.
Same stocks, and that will create opportunities in the other stocks that may be a lower amount of valuation in the same index maybe, or even outside of the index, for example. So there's that. And also I think it comes back to a lot of what we spoke about in the beginning of the podcast, when we spoke about pension funds and endowment companies and different institutional money that invest for different reasons and mandates and stuff like that. When you are constructing these portfolios, it could be that there is some index funds in there, but also sometimes, remember, these are portfolio managers, right? And portfolio management is a skill, is an art. It's an art and a science. There's a lot that goes into it. And it could well be that we've constructed a portfolio, but we need a solution to increase the I don't want to be technical, increase the risk in the portfolio. We need something different. We need something, do you know what I mean? And it could well be that actually, why don't we, this very specific mutual fund that only invests in companies that have high return to capital employed. This is a very unique term. That's what we want. We want that very unique solution, but in our portfolio. Because when we add that to our overall portfolio, we create a solution that makes sense for this specific client.
Okay.
Do you get what I'm saying? It's not just about putting all our capital in this one fund, because that's not going to outperform anyway. But when we add that fund to our portfolio, it creates this smoothie that actually tastes a bit better.
Okay. Interesting.
That makes sense, yeah.
This is, I like this conversation because I think sometimes we're so binary in our thinking and the way we think about things. Oh, passive investors is king. So why people bother active investing? And I think the way you've explained it makes sense, that there are going to be quite certain criteria for people. And it goes back to what you say, mandates, right? At the back end of it. Maybe some of these index funds are not suited to some people's mandates,
especially now. Yeah, especially now, because remember, like, you're dealing with serious money here, and you're dealing with, if an endowment requires an income, right, and a specific yield, or someone's already retired and they require a specific yield to live off, they can't invest in the S&P 500 because it yields, I think, like 1 point something %, right? Whereas that person needs at least 4 or 5% to live off, right? So that very simple example means you can't just invest in an index fund. Yes, someone might say, well, okay, well, at least if there's capital appreciation, you can maybe sell some of the capital appreciation and whatever. But that's not guaranteed, right? That's not guaranteed. And it's not guaranteed every year kind of thing. Whereas income is more predictable. Or bonds are more predictable, right? Like government bonds, gilts that I mentioned earlier are more predictable. It's risk-free, right? As they say. So yeah, it's, and this is what I'm really trying to teach retail investors, that yes, I get it, and I'm a retail investor too, and I had the same questions that you do, but it is very important to try and become very well educated. And one of the practices that I tell people to do is, whatever your thoughts are right now, write an essay with the opposite thought. And we call that critical analysis, critical thinking, evaluation, because it will help you to understand why something exists, and you're not so binary in your thinking to think it has to be this way. If it just has to be this way, then people like Warren Buffett won't exist, or Ray Dalio, or Peter Lynch, or whoever they won't exist.
Exactly. Yeah, and that's the thing. We're not saying that everybody needs to be Ray Dalio or Warren Buffett or stuff like that. But like you say, if we're going to argue that, then those people don't exist, and they do exist. They do exist, yeah. So it goes back to what you're saying. What is your risk tolerance, and how far do you want to go in this? Because there's going to be somebody out there in the world that's going to be the next Warren Buffett and next Ray Dalio. They've probably already there on their way to it. So, I think that is quite important. So, that mix between active investing and passive investing, it sounds like what you were saying before, the satellite approach would work quite well with mixing, so maybe your core is like your passive, and your active is the satellite. Yes, I like that. That's quite good, because it shows that you can combine both. And I think people should consider combining both, because I think everybody's just core. Not everybody, but I think some people just think just core, and I don't want to vanilla. I'm not trying to.
I hear it, but using myself as an example, I can never just be in index funds. Personally, not because I think they're going to be bad. No, I think if you had a conversation, you said, Jax, I'm going to invest for the next 2 decades, 20 years, and I'm only going to invest in the S&P 500. What do you think? And the question I'll ask you is, how often are you going to check your portfolio? If you said to me twice a year, I'll be like, okay, I like that. Cool. 20 years, you're going to check your portfolio twice a year. That's fine. I think you've got a good strategy. I think I would say that's fine. Index S&P 500 for the next 20 years, I think you do better than most people, right? But if you said to me, oh, Jax, I might check my portfolio maybe 5-6 times a year, or I'm not exactly sure if I'm going to wait for 20 years before I need this money, or anything that's different from what I said earlier, then I would say you need to reconsider, right? You need to reconsider, because the volatility you experience in an all equity portfolio, remember the S&P 500 is only stocks, it's only equities. You've forgotten about bonds, alternatives, and other asset classes, that exist, right? So you have to ask yourself, are you really willing to experience the volatility in this for the next 20 years? If you are, then absolutely go for the index funds. But the reason why Jacques Opoku can't just invest in index funds is I have too much of an interest in financial markets. I have to be involved. So I can't just leave it and set it and forget it. It's impossible. I will check, and I know myself. I'm conscious enough to know that for me to have a portfolio that I'm going to stick to, I need to be involved.
Yeah.
So does that mean I'm not going to invest in index funds? I am. In fact, I prefer multi-asset index funds because they allow you to choose your risk appetite. Adventurous, balanced, cautious, right? Once that's done, then I can have a bit of fun with my own portfolio. And that will keep me in the game.
Yeah.
And chances are I'll do better.
Okay.
I'll do better than myself. Not better than anyone else who has an index fund, but I'll do better than if I was just an index fund because I will get bored.
Okay.
Does that make sense?
Fair enough.
Yeah.
Look, this is why we have these conversations, because I think it's good, it's useful to really pick the brains of somebody that's worked on the institution side, and especially, around that thinking, and then see how we can apply it to like what we're doing day to day. So this is my final question for you before, I ask where can people find you. If you're building a portfolio today, and I know you're saying the 6-figure thing, the volatility and stuff like that. So, but I'm going to ask you anyway, if you're building a portfolio today for the next 20 years, what themes would you make sure was included in that portfolio?
I like that question. And like I was just saying, it's fun to be more active in the financial markets, which is why I just can't invest in the S&P 500. And I think before I even get to my answer, you can invest in like a world index or the S&P 500 and capture a lot of themes, because these index funds are quite self-cleansing. The best companies are going to be in this Premier League, right, of stocks. So that's fine. But for me, if I'm constructing a portfolio, I would adopt a core satellite approach. But in terms of my satellite, which is my active investing, there are certain themes that I think are really going to be important for the next few decades. And it's about looking at demographics. I think one of the themes that I see that's obvious, and I think many people see it, is the aging population, right? So, people are having less kids, for example. People are living longer. What does that mean? And how can we invest with this knowledge? It means maybe I should be focusing my portfolio on healthcare. That's one example, right? Because they have money and they're probably going to be spending on healthcare, right? So there's that perspective. Other themes, I think it's obvious that we can't turn a blind eye to artificial intelligence.
It's impossible.
We can't turn a blind eye. So most definitely I'll be looking at the technology sector. I'll be looking at who are the ones who are at the top of this new revolution, who are the ones that are also not just on top in terms of the providers, but also who benefits, what companies benefit from AI, who are the ones who people may not be talking about a lot. So it could be like, I was reading somewhere the other day that there are these companies that help cool down the use of AI or something like that. Whoever creates it, and I don't know. I didn't read much into it, but it's something I'm going to read into. And that's an area that I'll be looking at. Data centers. So if you're talking about like REITs and stuff like that, maybe I might be paying attention to the data center segment of REITs rather than
I've seen
retail.
one actually, a REIT that we'll talk about it offline. If I can Google it. There's one I think that's already big in that space. It
probably is one that I know as well that I'm probably already invested. But we can talk about it offline.
These guys, man, they're so ahead of the game. So you're like, how are you already thought about this stuff? Like,
there's always one. There's always a few that are ahead of the game. But no, I've just looked to see what themes are emerging. Another one that I spoke about a bit earlier, I think I touched on it, was the private markets. Private markets is an area that a lot of retail investors will struggle to have access to, but there are ways to get access to private markets. One of the ways is through something called investment companies or investment trusts. Some of them will have like private equity, or they might focus on private equity and stuff like that. So that's another area that I'm actually actively looking at right now. How can I gain further exposure to private equity? How can I gain further exposure to infrastructure? And the reason why I like infrastructure, which is an alternative asset class, is because it produces a lot of inflation-linked income. And I personally believe that inflation will probably be around for much longer, and I think it'll be higher than it has previously been. And so those kind of like inflation-linked cash flows will serve a good purpose in my portfolio. And by adding infrastructure to my portfolio, it adds a nice level of diversification to my portfolio because it has a different risk to return profile to equities and stuff like that. So yeah, I'll be looking at lots of this stuff, biomedical science. there's a lot of stuff to research, which is why
Yeah.
it goes back to what I was saying. I have too much of an interest in financial markets for me to just be in an index fund.
Okay.
But I'm still humble enough to understand that I'm not going to outperform the market as a retail investor. So I'm going to make sure a big proportion of my portfolio is just capturing the market.
Yeah. Your core, and then you've got your satellite, which is the fun. Yeah, that's good. It's good. And I think this is the way, like you say, it's a smart way to blend it and still build your wealth. And it's like you say, you have an interest in the markets, but you're doing it in a way where it's not having an impact on, you know, how you're building wealth in the majority of what you've got. Thank you so much, Jacques. It was great having this second conversation with you. I learned a lot, to be fair. I'm not going to lie. I learned a lot from this conversation, and I know that the audience learned a lot. So thanks so much for sharing, like, you know, your experience in the industry. I think it's so valuable for us, especially as, you know, in the UK, we're trying to get more people to talk about investing, actual investing. I think it really does, you know, give that insight into how, you know, the institutions really think, because I think there is a bit of a misconception with how that is sometimes and how they operate. So I think you really just you know, really shone a light on that. Where can people find you if they want to reach out to you?
Yeah, so as I said, I do a lot of one-to-one coaching and group coaching, and I do speaking engagements as well, and that's through my personal brand, which is Jacques Financial, JAX Financial. I'm predominantly on Instagram. I'm on TikTok now. Yeah, I'm on TikTok. Okay. Yeah, I'm on TikTok.
Actually, I think you're doing quite well on TikTok.
I'm not too bad. I'm also on YouTube. So that's Jacques Financial UK, I believe, on YouTube, which I'm going to be focusing a bit more now that I've got a bit of time in my hands. So that's Jacques Financial, my personal brand. You could book a one-on-one with me, whatever. And then probably the one I want to promote a bit more now is even Woke Finance, where we're working with a specific group of young people. So if you have access to, let's say, youth justice, or young people that might have challenging behavior, maybe an alternative education, and are between the ages of 11 to 21, these are the young people that also need hand-holding, a bit of love to say, and teach them personal finance, teach them about credit scores and debt management and how to make more money the right way. And that's Woke Finance. We have an audio-only podcast, which I'm trying my best to get my business partner to make it more visual. I think he would agree at some point. But if you search for Woke Finance on all the platforms, you'll find us. We've got over 200 episodes talking about all things finance, all things finance.
That's good. 200. How long have you been doing it for?
Oh, we've been doing it for about 5-6 years.
Wow, 200. That's crazy. That's well done.
It's a lot of episodes.
The 200 milestone is amazing, honestly. Well done.
But we talk about everything in finance. And Peter, he asked me some very nice questions. He's a good friend of mine. We've known each other for over 20 years.
Wow.
So audio only, but I guarantee there's a lot of good quality content on there.
I mean, audio. To be fair, funny enough, I don't know. I listen to most of my podcasts in audio. It's funny.
Same.
Yeah, I listen to most. I listen to podcasts on walks, gym. If I'm cleaning up around the house, I do watch as well. I do both, to be fair. I enjoy both equally, to be honest with you, actually. So I like having both options. So that's cool. Yeah, make sure people to go and check out Jackson, reach out to him through all of his social channels. Like I said, bro, appreciate you so much. Thank you so much for sharing like all the gems. We'll definitely do a part 3 because, you know, I think the stock market right now is in a very interesting era and a lot is happening, you know, at right now. And I've got a lot of interest in the stock market as well. That's just because that's the way I am inclined as well. And I'm just very looking forward to seeing what AI is doing and everything else like that. Do you have any final words for watchers and listeners?
Yeah, I think just to wrap up what I said earlier, the best investment you can possibly make is the one where you're going to get positive returns. Probably want to add positive returns above inflation, but the one that you can stick with. That's the most important thing. Of course, when we talk about investing, we have to do all the disclaimers. I'm not your financial advisor. And I think you could put a disclaimer on before we even start the conversation. But yeah, I think I would love more and more people to have the conversation. And I think what you're doing is truly amazing. I think we want to keep an open mind to make sure that we learn and we don't close it to say, oh, it's just index funds or it's just stock picking or it's just crypto or whatever. There's a whole world out there of assets and we can definitely learn and become much better investors if we're proactive and intentional about it.
Thank you so much. I really appreciate you featuring on the podcast. Thanks so much for tuning into this episode See you next week's episode. If you enjoyed this episode, share your favorite part in the comments, tap the like button and subscribe to the channel. Your support is really appreciated. We'll keep working hard to bring you more valuable conversations.